Good morning. This is Joe and Taylor with another session of Market Update. This is part two in our series of Should I Buy or Should I Wait? And today we're going to talk about what we feel is probably last week we talked about the question of inventory. This week we're going to talk about something that's on everybody's mind. It's all over the news. You're probably getting spam emails about it. We're going to talk about interest rate. Interest rate, Joe, is something that has always driven our market. It's driven buyer confidence. It's helped people decide if they should buy or should they wait. So what do you got on interest rate?
Yeah, so I got into real estate in 2001. I think you were 03, 04. Interest rates at the time, it seemed like we're about 7.5. I know as we got down into the sixes, everybody thought the rate was amazing. I remember when the market crash happened and people were getting loan modification offers under 5, it was like basically the heaven. Like the world is, all is right in the world and interest rates pretty much free, and like people were so excited at that point. The crazy thing is we now are into the 3s. I know I have clients who purchased multi-million-dollar homes with private banks here locally in the 2s. And so like interest rates are crazy. And I think you and I talked about how good it would be to kind of explain what that means. Like, why do interest rates even matter? If I'm a potential buyer and I'm thinking, man, it's hard to get a home right now because it's so competitive. What are some of the advantages to purchasing right now because of interest rates? And so I think that's kind of this part one. We talked about inventory and how does that affect things, and we hinted toward the next video we're going to talk about interest rates and how that affects things. So I think it gives a big picture where we as real estate professionals, you and I, and we teach our team to practice with integrity. So we're not just always like buy, sell. I think our goal is always to educate people and help them make informed decisions so that if they decide to buy or sell, they know why they're deciding to do it. So anyways, I think interest rates are a really interesting topic that, to be honest, when I got into real estate, I didn't even consider or look at. But
Great. Yeah, great intro there. And I think just to kind of set the stage a little bit for what you're going to talk about with this power of the interest rate, the thing that we get the most when it comes to new buyers, old buyers, any buyer, when they're looking at a house, the two things that most buyers look at is number one, what is the price of the house? That's kind of the first thing we look at, the price tag. But the second thing that usually comes up and is ultimately even more important is what is the monthly payment? Most people aren't paying cash. Most people are using a loan of some sort. So monthly payment is the biggest factor. That's kind of the day to day, month to month, where it really hurts is, can I make my payment? So I think looking back, I was looking at the very first house that I ever bought. I think our interest rate was around 7%. That was in 2001. Monthly payment, it seems like we bought this house for $130,000, and I want to say the payment was like $1,200 a month or something like that.
right.
And that was a lot of money. But fast forward into today's interest rates, what does the interest rate mean? Like if somebody bought a house in the 70s, 80s, 90s, 2000s, today, how has the interest rate changed and how has that monthly payment changed?
Yeah, let me pull up that graphic. And I think it's important for potential homebuyers to recognize, like, a lender doesn't say how much do you make, therefore how much of a home you could buy. It's not like if you make $4,000 a month, there's a 100x multiplier that says you can make $400,000 home payment. Like you could buy a $400,000 home. Your monthly income does determine your purchase price, but not the purchase price itself. It's like if you make $6,000, it's not like, oh, I could buy a $600,000 house. It literally, every single component depends on how much of a payment you could afford, and then how much with current interest rates would that payment translate into on a purchase price. And so every once in a while, we'll talk to someone who's thinking of buying a home and we'll say, do you know how much of a home you're looking to buy? Or new agents will look for a purchase price in saying like, I'm looking to spend 500 or 600 or 700. Experienced agents very much focus on that payment, because in reality, that is all that matters. In a fixed interest rate situation, all that matters is how much is your payment. Because I'm going to show this graphic of what a $300,000 home would have cost in 1970 all the way to now. So let me try to share my screen. This is the first time I've done this on this new.
While you're messing with that, Joe, another thought on interest rates. There's a few things to consider. I think what makes interest rates go up and down, kind of like what you talked about. What does the monthly payment? How does a lender calculate how much each buyer can spend? And it's based on debt to income. So, for easy math, if somebody makes $10,000 a month and the lender says your total debt to your total income cannot exceed 40%, that means the total debt cannot be over $4,000. So, interest rate, when you look at that and what the payment on a house would be, as that payment, as the interest rate goes down, then it allows a buyer to have a bigger house, a bigger payment, because the debt to income factor is there. So
right.
I think that as we look at all these different things, these factors, why the rates go up and down, that's what we're trying to determine is should we wait or should we buy now? If prices go up, is it better to wait till they come down? But if they go down, have interest rates climb back up to where the payment's going to be exactly the same, the debt to income is going to be exactly the same. So even though I can get a better price on a house, the interest rates are higher, therefore my payment's exactly the same as it is today.
Yeah, and it's that debt to income issue is really important as well, because I think people sometimes will believe, all right, let me know if you can see my screen there.
Yep, I got it.
Okay, so here it talks about the price of the home being $300,000, and just saying by decade, how much would that $300,000 home have cost you? So in 1970s, when you and I were born, our parents could have bought a $300,000 home with an 8.86 average interest rate. So they averaged the interest rate throughout the whole decade for $2,384 a month. Now the 80s got worse. Interest rates went up to where the average was 12.7. I can't even imagine that. And at that point, the monthly payment on a $300,000 house was $3,248. In the 90s, 8.12 interest rate, $2,267. The 2000s, when you and I both entered the real estate market, 6.29 would be $1,855 a month. It went down in the 2000 teens to $1,448 with a 4.09. Right now, a $300,000 home would cost you $1,270 a month. So it's important to recognize, like when somebody says, hey, I'm thinking of buying a home, and then a real estate professional says, okay, do you have any idea how much you'd like to spend? If you're a home buyer, the response should be based on your monthly payment, not based on your total purchase price of a home. Why does that help the real estate professional, Taylor? If somebody says, I'm comfortable up to $1,800 a month, how is that so much more informative than somebody going like, I don't know, maybe $450?
Yeah, so if it is somebody that's paying cash, then we ask the opposite question: how much cash do you have? How much do you want to spend? But most of more than 80% of our buyers are buying with a loan. And to answer your question, if they're buying with a loan, we don't care how much they want to spend on the price of the house. We care how much they can qualify for. So before we can go and be competitive in this market, as you know, we talked about inventory last week, but such a competitive market, it's a seller's market, and for us to get offers accepted, a buyer has got to be pre-approved. That means they have got to have had a conversation with the lender, they've submitted all their paperwork, they've done a few things. It's a very simple process, but the lender,
right,
after looking at the taxes, looking at a few bank statements, talking to them, having a short intake analysis of what's going on with that buyer, can determine how much of a payment they can afford. So, when you say, why is it more important to say I can afford $1,800 a month versus I want to buy a $500,000 house? The $1,800 a month is a much clearer, more honest projection of what we're going to be able to spend, what we're going to be able to get qualified for. And it's going to help us go and be very competitive when we start submitting offers and trying to lock up that perfect house.
Right. So we had a question, which was the payment So Krista's right. She said that payment calculation does not include taxes and insurance and things like that. So you're right. This is the calculator I showed is purely the interest cost of the money with the principal amortized over 30 years. So those numbers that I quoted as far as in the 70s at 8.86 at 2384 is principal and interest, but it's not taxes and insurance, if that makes sense. So that's based on a 30-year loan at whatever interest rate that was quoted. So we started to touch on debt to income ratios and why those are important. So Taylor, how does it, if somebody makes $10,000 a month and they've got $1,000 car payment and $1,000 in credit card payments, there may be a theory that they could then spend $8,000 a month on a house payment. And, talk about lender restrictions on debt to income ratios and why those are important.
Well, so, we talk all the time with our team here that when it comes to certain areas of expertise, we always recommend talking to the professional. So full disclosure, Joe and I are not lenders.
We're not lenders, right?
Yeah, we talked to a ton of them. So I'm going to give kind of the 30,000 foot view, broker, salesman, real estate agent thing. But the way that works, if somebody makes $10,000 and says, I have $1,000 in credit card debt, I've got $1,000 car payment, therefore I can spend $8,000 a month on my mortgage, which means I can go and spend a $2 million. I can go and buy a $2 million house with an $8,000 mortgage. But the way it works, lenders are probably, since the Great Recession of 2008, have learned a lot about liability, about protection, about not being marked as predatory lenders. So they're very conservative when it comes to making sure that the buyer is safe and not putting them into a loan that they cannot afford. So they want to see some reserves there. If the buyer, that's why most, I think, again, the numbers here are going to be a little off, but I think FHA can go up to like 45% debt to income. So with all their debt and the house payment, they can go up to about $4,500 a month, which means
so.
Go
ahead.
So
if somebody said
$5,500 in extra reserves to cover anything that comes up, emergencies, car breaks down, somebody has to go to the doctor, whatever it is, there's a major catastrophe, they can cover that expense and continue to make their payment.
Yeah, so if somebody's sitting on their couch going like, all right, I want to buy a home, based on that calculator that they showed, at a $300,000 home, principal and interest payment right now is $1,270. I make $10,000 a month. I can afford, like Taylor said, you can't just say my current debt servicing is about $2,000 a month. I can afford an $8,000 house payment. The banks will limit you to about 45%, give or take, in debt. So if you make $10,000 a month and you have $2,000 in current debt obligations, you have about $2,500 to play with as far as a mortgage payment is allowed. They're not going to let you finance up to 75% of your monthly income. And so there are some restrictions there. Like he said, obviously lending professionals will give you a better concrete idea based on the loan program you would qualify for, what your debt to income ratio is allowed to be. But it's important to recognize that just because you make $10,000 a month doesn't mean lenders will loan you up to $10,000 a month in debt. And that kind of helps you keep things in perspective. But I think a key thing to recognize is the danger zone we're in right now is somebody who says, I'm going to wait for the market to crash. People have been saying that for 5-10 years. Like ever since the last recession, everybody's sitting on the sidelines waiting for the next crash. I tell people, I don't know that I would speculate on today's market. Like, I don't know that I would buy 7 homes hoping that renters will show up and hoping the appreciation continues at its current rate. But Taylor, when somebody says, I'm going to wait until next year, or I'm going to wait 2 years down the road. When it comes to interest rates, what's the danger in somebody waiting for 2 years to buy their next home? Because how does it affect things if interest rates are still historically low? Let's say they go to 4.75. How does that extra 1.25, 1.5 of interest affect somebody's ability to purchase and their monthly debt servicing?
Yeah, so as you're talking there, I was just messing with my little calculator here. So just to give a perfect example of this, today's market, if somebody bought a house for $500,000 and say we found a rate for 2.75, which is low, but it's out there, 2.75% at $500,000, that's going to get you right around $2,700 a month. That's principal, interest, taxes, insurance. So if the interest rate goes up to 4.75 on that same $500,000 loan borrowing, you'd be at, your payment would then go to, let's see here, messing with this, it'd go to $3,243 a month. So $500,000. So it goes up about $550, which to keep the payment at $2,700 a month, if the interest rate was at 4.75, you'd have to be at $416,000. So basically, you lose about $84,000 in buying power if the rates go up that much. Not to mention the write-offs, not to mention the appreciation, not to mention all the other benefits you get of owning a home.
Yeah. So our advice as far as buy or sell right now, we don't, like, we're always very careful because we want to, any client we work with, we want to see them at the movies in 2 years and them still talk to us. And so we never force anyone into any decision. We basically provide advice, and then we go to work really hard to make whatever decision they make happen to their, to their best possible outcome. So if somebody asked me right now, like, hey, Joe, should I buy a home? I would tell them, don't be fooled by the high prices, because all that really matters to you is your purchasing power per dollar spent. I don't have a crystal ball, therefore I can't look and say, if I did know, it would help me make a decision on selling my own home and buying my next home. Our problem is, Taylor and I have talked personally, it's like, it'd be cool to sell my home right now because it's really high and interest rates are really low. But then what would I go buy? There's nowhere for me to go. But I also am not in a situation where my family's growing or shrinking. I'm also not in a situation where I need a place to park a boat. I need a third car garage. Like most people in Vegas, we've gotten out of the valet parker buying 7 homes to rent out. Like, it's when people are buying and selling right now, they're buying and selling because life happens. They get married, they get divorced, they're having children, their kids are leaving for college, they need extra garage, they need RV parking, whatever it is. And so now is a great time to buy. Now is a great time to sell. That's why our market is so healthy. Someone can sell their home and make a bunch of money, assuming they have somewhere to purchase and move to. And so I personally would not shy away from purchasing in today's market, because you're at this perfect precipice of interest rates and payments. And, like if I go buy a $700,000 home, right now my payment may be $3,400 a month. And if interest rates go up a point or two, that same home might cost me $1,000 a month more. So it's kind of this perfect intersection of interest rates and purchase price ability.
And one thing too on all of that, I get the question all the time is buying a home right now a good investment? And the thing that I always rebut that with is, well, with investment we invest to get a return. And the question is, well, what kind of return are you looking for? Are you looking purely for a money return? If so, then buying a home right now to live in as an owner-occupant could very well be a good investment. But the bigger question is that investment, that return, raising your family, having a neighborhood that you love, having cool neighbors, having maybe gated, maybe no HOA, whatever it is, the investment when you're buying a house to live in, our home we cannot think of as the stock market. We can't think of it as an income producing investment property, but it's our home. It's where we're building memories, we're creating lifestyle, we're creating just a place to, kind of a safe harbor, a place to go. So to answer that question, if you can afford the house, looking at the interest rates, meeting with your lender, own the house, make the payment, you have a great job, you feel secure and you can afford it and you love the neighborhood and you like the house, then it's an amazing investment. It's absolutely something you should do if you can check all of those boxes.
All right, guys. Well, in the long run, we hope that this helps. We've covered inventory. We've covered interest rates. Next week, we'll hit another topic. And I think our goal with this is just to provide counsel and information. So if any of these topics we've discussed interest you want to ask Taylor or I a question, text 702-336-8500. We will respond as quick as possible. All in all, our goal in this is just to provide advice. We've been in this for a combined 40 years. So we've seen growth, we've seen recession, we've seen regrowth, we've seen buyers markets, sellers markets. My advice right now is if you're looking to purchase a home, to raise a family, to retire in, whatever, focus on the monthly payment. Take advantage of the really, really low interest rates. Set up shop, set up home. We've seen how important home is during this pandemic, and people, I think, have recognized, like, man, I better be really happy in my home, because heaven forbid something happens in 2 or 3 years and we're locked down again. Like, I can't fathom doing that in the home that I'm currently in. Buying a home for a doomsday scenario is not a great decision, but when you take all the factors like Taylor talked about, raising a family, like enjoying your life, enjoying your situation, my advice is take advantage of the interest rates right now, because we'll probably have low rates for the next year or two, whatever it is, but 3.3% average interest rate, or 3.03% average interest rate now is insane. So anything else, Taylor?
No, just let us, if there is anything at all that we can help you with. We do this full time. We've done it for a long time. We really love not just meeting people and getting a check, but we love building relationships that last a lifetime. Most of our business is repeat business, that people we work with forever, and would love to answer any questions. There's no cost for information, and we're here to help.